Welcome, students. My name is Professor Min Win, and welcome to our class, Act Right 101. And today's topic is everything you need to know about your mortgage payment. I'm kidding, guys. I'm kidding. But I wish in high school someone would have taught us on how to calculate your mortgage payment instead of me taking teacher aid classes or attendance monitoring classes. If there was an Act Right 101 that prepared me for life, I would have taken it. And I wish they would teach how to calculate your mortgage payment. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor. Going blank right now. Do me a huge favor. Hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night at 9 p.m. and we post content daily on Instagram and TikTok. Also, this is an interactive live stream, so ask a lot of questions. And if we bring you any value tonight, do me the biggest favor. Save this video. Save it, right? I see a lot of people ask me the same questions over and over again. Save the video. It helps a lot, right? So guys, let's get into it, right? Everything you need to know about your mortgage payment. So there's two things you got to know before you start busting out that mortgage calculator. Number one, you got to know what's included in your mortgage payment. A lot of mortgage calculators out there don't have the complete payment, right? You get excited, you fall in love with the house, and once you get the rest of the items, the payment is too high. So you gotta know what's included in your mortgage payment. It also helps you with your debt to income ratio. If you haven't seen our video on debt to income ratio yet, go ahead and check it out on our YouTube channel. Definitely, it will show you how to budget for a mortgage payment. And once you know everything that's included, how do you calculate each item? Tonight, we're going to show you how to calculate each item. Like I said, Act Right 101. And tonight, we're going to show you how to calculate each item so you know what's included in your mortgage payment, right? How do you calculate something? How do you know where the end of the race is if you can't calculate the distance? How do you know how much to save? How do you know what jobs to take? How do you know what debts you can take on if you don't know how to calculate your mortgage payment? If you knew where your mortgage payment's going to be, you're like, you know what? Let me hold off on that car. Let me hold off on that Bowflex, right? It all depends on your goals. But if you knew how to calculate your payment, you know what to do. First, what's included in your mortgage payment, right? Because a lot of mortgage calculators are missing some things, right? So this is what's included in your mortgage payment: your principal and interest payment, your homeowner / hazard insurance. There is a difference. Private mortgage insurance and your property taxes. Okay, so these are the main items included in your mortgage payment. If you're using a mortgage calculator and you don't see these 4 items, make sure you add them. Okay, so let's talk about your principal and interest. When you make a standard mortgage payment, a standard, of course, there's something called home equity line of credit and interest-only loans, but tonight we're talking about your standard mortgage payment. When you make a payment, right, if you borrow money, you're typically paying back the principal and the interest. And they've calculated the formula on how much you need to pay back the principal and interest with a steady pace. And they do it through amortization. So there is a formula that banks have put together, and they front load all the interest because they want all their money first, because they're taking on all the risk and loaning you that money, and they amortize it either over 30 years, which is your standard loan, 25 years, 20 years, or 15 years. But you can get crazy too. You can do a 22-year fixed loan. You can do a 21-year fixed loan. You can do a 17-year fixed loan. You can decide the amortization. Especially if it's your second or third home, you feel like you don't want to do another 30-year fix, you can do a shorter term. You're coming in with tons of equity. Or if you had a home and you've had that loan for over 10 years, you might not want to go back to a 30-year fix. You can refinance on a 20-year fix. Let's say you've had the home for 12 years, right? You can do an 18-year fix. There's a lot you can do, right? But you want to see when you make your payment, what goes towards principal and what goes towards interest, right? So that's why it's important that you know how to calculate your principal and interest, right? So here's an example. Here's an example, right? So let's say on a $500,000 loan with a 5% interest, rates are not at 5% as you're watching this right now in October 2021. This is just an example, right? On a 30-year fix, on a $500,000 loan amount, the payment's going to be $2,684. And in 30 years, you will pay back the $500,000 in principal plus $466,000 in interest. But let's say you go with a 25-year fix. Your payment would be $2,922, but you're paying back $376,000. A 20-year fix, about $3,300. You pay back $291. On a 15-year fix, you'd pay back about $39.53 and pay $211,000 in interest. Remember, the shorter the term, the higher the payment, but the lower the interest as well. Like I said, mortgage payments is not for the faint-hearted, so a lot of people do go with the 30-year fix first. But if they're used to a mortgage payment, or like I said, they're selling and upgrading, or they're refinancing and they don't want to go back to 30 years because they care about a lower payment, but they're not trying to stretch it back out, they normally go with a shorter term loan. Okay, so now that we know that there's principal and interest, the next factor in your mortgage payment is your hazard insurance. So hazard insurance is mandatory if you are financing the property. Unless you're getting a condo, then in the condo it's covered, right? But if you are buying a single family home, a townhouse, a duplex, triplex, or fourplex, there will be hazard insurance if you finance it. And it's there to cover any damages in the house from natural disaster. Hazard insurance is there to protect the lender. When you buy a home, there's standard hazard insurance. Unless you're trying to go for the Ferrari, right? The Ferrari version is homeowners insurance. People didn't know there was, I learned it as well. It's different. You can get basic hazard insurance or you can get homeowners insurance, which includes hazard insurance plus various types of protection from various types of damages such as theft, any medical bills from any injuries that someone got hurt on your property or in your property. The homeowners insurance protects the lender and protects you from any incidents. Typically, when you get hazard insurance, you're going to pay 1 year up front, and then if your account is impounded, that means you make your mortgage payment with your tax insurance, they collect your hazard insurance and they pay it the following year. But if your account is not impounded, they typically will pay 1 year up front, and then the following year, they will send you a bill for hazard insurance. That's a second main factor included in your mortgage payment. The third one, which is not optional, if you are putting less than 20% down on a conventional loan or you're going with an FHA loan, there's private mortgage insurance, okay? So what is private mortgage insurance? People ask me all the time. That insurance is there to protect the lender. If you were loaning out money and someone didn't come in with a lot of collateral, with a low down payment, it protects the lender in case you can't make your mortgage payment and they gotta foreclose. And there's not enough equity when they foreclose, that insurance pays them back any losses. So when you are going with an FHA loan, there is upfront mortgage insurance and there's monthly mortgage insurance. You cannot get around that. And if you're going with a conventional loan, there's 4 types of PMI. There's monthly, which we'll talk about later. There's single premium, which means instead of paying it monthly, you pay a lump sum up front. And it doesn't matter if prices go up or down, you won't have private mortgage insurance. And the third way is split, which means it's a blend of a little bit of monthly and a little bit upfront. And the fourth type of private mortgage insurance is lender paid. So don't get all excited going, oh my gosh, I talked to this one lender, I'm doing less than 20% down, but they don't have private mortgage insurance, right? But guess what? It's rolled in the interest rate. So typically you will take a higher interest rate to cover the private mortgage insurance. Okay, now that's the third factor included in a mortgage payment. Of course, if you do 20% down on a conventional loan, you will not have it. Now the next factor is your property taxes, right? The fourth factor in your mortgage payment. We went over principal and interest, hazard insurance, private mortgage insurance, and the next one is property taxes. It is a cost of owning land in a specific state. It's the one bill that will not go away. Every city has a different tax rate. The county assessor will assess it at the purchase price. If you want to know what your county tax rate is, definitely call your city tax rate is, call your county and tell them the cities that you're looking to buy in and get the city tax rate. And remember, every state differs on how they reassess the property. If you buy a home, Like, for example, in the state of California where I'm from, if you buy a home, you're protected under Prop 13, which means they can only reassess your property 2% a year. Okay? But if you change the name of the people on title, they will go out and reassess it at the new value. For example, you bought a home, 10 years later, you add your cousin or you add somebody, right? They're going to reassess it with the value 10 years later, which can drive up the property taxes. Also, if you do any home improvement that requires permits, right? It's like a catch-22. You live in your house, you plan on living in it for a long period of time, you add a pool, you add square footage, right? You go out and get permits 15 years later, right? If you go out at 15 years later, now it's not the price you bought it at, they reassess it at the value 15 years later. I see a lot of people when they inherit the property from a family, from their parent or grandparent, right? They got the lower property taxes, they're excited, but since the home has tons of equity, they go out and they do upgrades. If you do any upgrades that require permits, beep, it will bring up your monthly property taxes. Okay, so those are 4 main factors that are included in your mortgage payment. You got your principal and interest, you got your hazard insurance, you got your PMI, you got your property taxes, and I forgot the 5th, right? Homeowners insurance. HOA. There's some HOAs in this house. There's some HOAs in this house, right? Homeowners Association, right? HOA. If you are buying a home in a community, there is HOA. If you're buying a condo, there will be HOA. I see people forget to tell their lender, or they're trying to calculate their mortgage payment, and there's no HOA section. Remember to include your HOA, right? If you don't include your HOA, your DTI will skyrocket. I see people qualify to buy a home, right, Rosalinda? You laughing now, girl, right? And you don't include that HOA, and that HOA drives up the price, drives up your DTI. You can knock yourself out from qualifying, right? Some people qualify to buy a home, all of a sudden they get excited, but then they go out and they fall in love with some condo, and that condo has a HOA, and if that you find out that monthly HOA payment, and that monthly HOA payment is a little too high, guess what? You just drove up your DTI. It could knock you out from qualifying. You might have to come in with a bigger down payment, pay off some debt, or add a cosigner because that HOA bill is expensive, right? Homeowners Association is part of your mortgage budget. When you're trying to calculate your DTI, don't forget it. Even though when you make your mortgage payment, it doesn't include the HOA payment. It's a separate bill, but you got to count it, right? So those are the items that make up your mortgage payment. If you found this video useful, do me a huge favor. Save this video, share this video, and like this video. And also, if you're not following us by now, please hit the subscribe and notification button so you're notified every time we post new content, right? I'm laughing because Rosalinda's laughing right now. Now that we know what's included in your mortgage payment, right? You got your principal and interest, you got your hazard insurance, you got your private mortgage insurance, you have your property taxes, and some of you who are buying a community, you have your HOA, right? Your Homeowners Association. Now, let's figure out how to calculate your mortgage payment. Once you know what's included, how do you calculate each item, right? So tonight, we're going to give you the factors to calculate each item. Before calculating your mortgage payment, you got to know these things up front. You got to know the purchase price. You got to know the down payment. I'll answer that question in a second, Laura. You got to know the loan amount. You got to know your amortization schedule. Remember, is it a 30-year fixed loan? When using the mortgage calculator, they typically will say 30-year fixed, but you're going to do a 25, 15, or shorter term. Make sure you know what's your amortization schedule. You got to know the interest rate, right? Tonight, we're going to tell you where to find interest rates without talking to a lender, right? Sometimes you want to calculate the payment, but you don't want it to be sold. You want to know the homeowners insurance and hazard insurance formula that underwriters are using to calculate your payment. You got to know the PMI formula, the property tax formula, and of course, you got that HOA again, right? What is the payment? That's the only factor that doesn't have a formula because every HOA is going to be different. There's no actual percentage, right? But make sure you know all these items when you're trying to come up with your mortgage payment. So let's talk about the purchase price, right? So you want to go on Zillow, Redfin, Homes.com, or if you're talking to a realtor, right? Look up what the average purchase price is in the area you're looking to purchase in. Without that purchase price, you cannot calculate your mortgage payment. So that's why a lot of you guys reach out to lenders and you tell them, hey, this is what I qualify for, right? And they'll bust out the numbers, but it might not be the home that you want. And a lot of you guys, you go through all this work and your heart's broken. That's why if you learn how to calculate your mortgage payment yourself, when you talk to a lender, you're not setting yourself up for a disappointment or like, man, back to the drawing board, right? So look up the purchase price. Next thing is your down payment. Without your down payment, you can't figure out what your loan amount is. If you haven't seen our video on down payment yet, go ahead and check it out on our YouTube channel, right? Under everything you need to know about down payment. So how to use a down payment and what is a down payment percentage. Remember, when you're saving for your down payment, you're saving by percentage, not dollar amount. You got to meet the minimum down payment requirement. You can increase the down payment if you're chasing a specific mortgage payment, but you got to know the percentage. Of course, if you're going with a VA or USDA loan, it's 100% financing, but your standard down payments are going to be 3% down, 3.5% down, 5, 10, 15, 20. Of course, the greater the down payment, the lower the monthly payment. If you don't know what's your down payment, definitely download our Ultimate Mortgage Guide. Go to whatsamortgage.com and download our Ultimate Mortgage Guide. It will give you the information so you have the confidence to choose your down payment. If you know how to calculate your mortgage payment, you can decide how much you want to bring down, okay? This is how you calculate your loan amount. You need to know your purchase price first. And you got to know your down payment. Without the purchase price and down payment, you can't calculate the loan amount. So, for example, here on $500,000, if the down payment is 5% down, that would make the base loan amount $475. A lot of mortgage calculators only have base loan amount. You need to know the base loan amount and the complete loan amount. On conventional loan, the base loan amount and the complete loan amount should be the same, right? So on 5% down of $500,000, right, that's $25,000. That would make the loan amount $475. And let's go with your FHA loan, right? So if you're going to go, I see some calculators, they won't even let you put 3.5% down. It's 5% down or 3% down. But if you're going to go with an FHA loan, make sure you know the minimal is 3.5% down. So on $500,000 at 3.5% down, it would make the base loan amount $482,500. But remember, with FHA loan, there's a complete loan amount. You got to add the upfront private mortgage insurance. If you're watching this October 2021, right now, FHA rules is the upfront private mortgage insurance is 1.75% of the loan amount, which means it would be $8,443 added back to the $482, which would make your complete loan amount $490,943, and that's important to figure out principal and interest. And on a VA loan, typically it's going to be $500,000 if the purchase price. There's no down payment. You got to add back the funding fee. If you're watching this October 2021, the funding fee for a first-time VA buyer is 2.3. But we left the link below right here. If you are not a first-time buyer and you want to figure out what your funding fee is, you can go ahead and check it out on our funding fee chart right here. I left you a link. But 2.3% of $500,000 is $11,500, which would make the complete VA loan amount $511. I see a lot of mortgage calculators don't have complete loan amounts for FHA and VA, so your numbers are off. There are people out there, and I'm not saying it's bad, but if you're a person out there that you want to know the mortgage payment to the penny, you cannot afford to use a mortgage calculator that doesn't have the complete mortgage payment, right? So now we know the purchase price. Now we know the down payment. It gives us the loan amount. The next step is interest rates. Let's say it with me, guys. Interest rate. That's what everyone's looking for. So this was pulled on October 12th, 2021. This is where rates are at. So these interest rates are an average of a 2-day locks, which means there's a company called Optimal Blue. I left you a link below. Optimal Blue is like the Google of rate search for mortgage lenders. Big banks upload their rate sheets to Optimal Blue, or they upload it to Loan Sifter for mortgage broker. And Loan Sifter is owned by Optimal Blue. And what they do is they take an average of interest rates locked in the past 48 hours. So on a 30-year fix, the rates right there, jumbo rates, FHA, VA, USDA, and 15-year, right? On the site, it'll give you in depth about FICO score, LTV as well. So definitely, you want to know where rates are at, right? If you want to know where the average rates are at, well, these rates are too high or these rates are too low. These are just average. They're taking the average lock, right? If you want to get to the nitty gritty, you got to talk to a lender, right? Rate sheets aren't just floating around out there. But if you want to know, hey, you know what, let me use this so at least I get a ballpark and punch it in a mortgage calculator, that's where you find interest rates, All right. And here's an example on how to calculate your principal and interest based on the interest rate. So for an example, on a $500,000 home with a 5% interest rate, conventional there's 5% down, FHA 3.5%, VA 100%. Remember, when you're calculating the principal and interest payment, you need to know the complete loan amount, which not a lot of calculators are accurate about, and you need to know the amortization. When you're using a calculator, what amortization are you putting on there? You're doing a 30-year fix, 25, 20. Remember, on a 30-year fix, on this conventional, the payment's $25.49, FHA 26.35, VA 27.45. As we go down from 25-year fixed, 20 and 15, you can steadily see, right, the monthly payments going up. So depending on the amortization and the rate, now you have your principal and interest payment. It's based on the complete loan amount. So now that you know how to calculate the complete loan amount, the next factor is your hazard/homeowners insurance. So if you already have an insurance company, you would call them, you would tell them scenario, they would give you a rough estimate on your policy premium. So typically you take the policy premium, you divide it by 12. If you haven't talked to an insurance company, how mortgage underwriters are looking at it, they take the purchase price. They either times it by 0.15 for basic hazard insurance or 0.20 if you're going to get the Rari, right? The Ferrari of homeowners insurance, and you divide it by 12. Here's an example. They take the $500,000, that's your purchase price, times it by 0.15 equals $750 divided by 12, that's $6,250. $500,000 times 0.20, if you're going to get the Ferrari version, it's $1,000, that's $83.30. But remember, that covers, besides hazard, that covers any theft, any injury, right, on your property. So remember, that extra $20 could be a game changer. It all depends what's important to you. So now that we know how to calculate the hazard insurance, the next factor is your private mortgage insurance. But remember, there's two types. There's FHA and conventional. Let's go over the FHA one. FHA, purchase price $500. On an FHA, if you put less than 5% down, the FHA monthly PMI is 0.85, right? So you typically take the base loan amount, you times it by 8.5, you divide it by 12. It's the base. Remember, when you're calculating the principal and interest, it's the complete loan amount. But when you're calculating the PMI, it's the base, right? So it's base loan amount times 0.85 divided by 12. So let's say on that $500,000 home, you go 3.5% down. The loan amount would be $482,500 times by 0.85 would be $4,100 divided by 12 is $341 a month. So if you're doing more than 5% down on a FHA loan, the monthly PMI rate is 0.80. So here's an example: $500,000, 5% down would be $475. 0.80, 3,800 divided by 12, 316. So now we know how to calculate the FHA PMI. It's important that you know that. We're going to show you a second to make your life even a little bit easier, right? Next one is conventional. So with conventional, it's a little bit trickier. It's based on your down payment, right? It's either going to be that 3% down at 97%, 95% right there. Go bigger on the calculate, go big, yeah, big screen, or 10% down or 15, right? Then you add your adjustments. Is it a second home? Employee relocation, manufactured home, 3-unit or 4-unit, lender paid, right? I wouldn't even look at the lender paid. I would pretty much, when you're using this sheet, it's in our Ultimate Mortgage Guide. It's also on our Techie lender calculator, which we'll go over in a second, right? Then, of course, is your DTI over 45% before you have your PMI? They take that as a risk. You add that risk. If there's 2 borrowers on the loan, the risk gets less. You take an adjustment off the PMI. So for an example, if your loan amount was $477, and after you calculate your adjustments, it's 0.44 is your monthly PMI, it would make the yearly PMI $2,090, which divided by 12, that's $174 a month. So every month you're gonna pay $174 a month until your PMI falls off because it's conventional. All right. Last but not least, your property taxes, right? So you guys got to know this. It's the purchase price times it by the tax rate divided by 12. Here's an example. On a $500,000, if your tax rate in your area is 1%, right? It's $5,000 divided by 12, $416. But if you're in that state of Texas, you're in a state that does not have state taxes. Typically, property taxes are a lot higher. So 500 grand times by 2.5, that's 12,500. That's 1,041 bucks. So if you live in Fontana and your purchase price was 500,000, you pay 416. But if you live in Texas, purchase price 500,000, you probably get a better home than you would in Fontana. You would get a better home in Texas than you would in Fontana. But your tax rate is 2.5. You'd pay $1,600 more. But remember, there is no state taxes. If you don't know what the taxes are in that area, right? Unless you're in a state that does not have state taxes, the underwriters at mortgage banks are using 1 1/4. So it's 500,000 times 1 1/4 divided by 12, which would make it 520, right? So those are the items right there that include your mortgage payment and how to calculate it. And remember the HOA, right? The Homeowners Association. Add that payment, right? So now we taught you how to calculate your principal and interest payment, right? Your hazard insurance, your private mortgage insurance, and your property taxes. Here's some examples for you. All right, here's an advance on a conventional loan. $500,000 purchase, 5% down, right? It would make the purchase price $500, the loan amount $475, 5% down, right? The principal interest $25.49. Hazard insurance, we went with the Ferrari version, $873. Property taxes 1 1/4. Monthly PMI 0.44. It'd be $33.28. Right? Let's look at your FHA. FHA would be the purchase price, the base loan amount, the complete loan amount, principal and interest payment, hazard insurance, property taxes, and PMI, right? 35.51. I think we did the PMI. It's the 0.8. It's the 0.85. I think our PMI. Yeah, the PMI payment is right. It's just the PMI rate supposed to be 0.85. That's it, Andy. So, guys, there is a mistake on here. That monthly PMI, the payment's right, 341, but it should be 0.85 on there. Okay. Last but not least, our VA. Purchase price, loan amount, complete loan amount, principal and interest payment, hazard insurance, right? The property taxes, and your payment's $33.49. Now that you know how to calculate your mortgage payment, now it's about the seesaw game. If you're a loan officer or realtor, or you're trying to figure out to maximize your qualification, you need to know how to calculate your mortgage payment so you know how to control your seesaw game, right? Seesaw means if that payment is too high, the only way to lower that payment is to drop the purchase price, right? Bring in a bigger down payment, pay off debt, even though paying off debt doesn't change the mortgage payment, but it gives you cash flow to afford that payment, or add a cosigner. That's why it's so important that you learn how to calculate your mortgage payment, because without that, you can't make the next step. And some of you guys, you're not in a position where you want a lender to run your credit, right? Am I right? Let me know if you're right. Hey, I'm not in a position to run my credit, but I want to know. That's why I wish they taught us this in high school. My senior year, I wish Act Right 101 was on there, and the topic was mortgage payment, not these electives that didn't further my life or better my life or put me in a position to be successful, right? So definitely, guys, understand how to calculate mortgage payment. I know sometimes it's boring, but it is useful. But let's say, man, these are some crazy numbers. I love you. I listened to the end, but I don't want to calculate. Is there a better way? I'm about to tell you right now. Guys, if you found this video useful, do me a huge favor. Save this video, share this video, and like this video. If you're not following me right now, hit the subscribe and notification button. So, my boy James Williams put something together called the Techie Lender Calculator. It's techielender.com, and let me show you how it's done, okay? All the formulas are in there for you if you go with the automation. Let's go through in just 1 second here. Let me show you. So if you do have a purchase price, it will calculate it for you, right? So let me know what your purchase price is. So, guys, does anyone have a purchase price here? And it will calculate it for you. So here it is.
You should probably start off with the purchase price.
So we go with, let's say, conventional loan. Pick the state. You can pick the county. This is built for California. Outside California, we'll go outside of Cali. Single family home. Let's say it's 445. 445. 445 on here, right? 445 purchase price. Let's say interest rates on a conventional today, I know, is 3 1/8. Right? The term is a 30-year loan. Let's say the down payment is 5%. Francis, what's your credit score? Down payment, it'll tell you at 5%. Your down payment would have to be $22,500. Your base loan amount, $422,000. Your LTV, 95%. Do you have an insurance quote? No. Right? If you don't have one, she has a 680. All right, 680. 680, the rate's gonna be a little different. So Francis, I'm gonna give you both payments, right? So hazard insurance, automatic $55. Calculating property taxes, yes, automatic 1.25. Okay, we'll go FHA. We'll go into conventional in just 1 second. Melrose, no. If you do have Melrose, it's calculated in your property taxes. Okay, so talk to your county assessor to get the property tax in your Melrose in your area until Melrose is over. It's not calculated separately. It's inside your property taxes, okay? So, Melrose, no. Is mortgage insurance required? Yes. PMI, yes, right? You can click here. So, if she had a 680, she did 5% down, it would be 1.28. Let's assume the DTI is under 45%, right? So, there's no adjustments. But if there's two people, she has a 680, 0.14, 5% down, 0.11. So 1.28 minus 0.11 would be 1.17. So if I go here and I put 1.17, right? I think rates, if she has that 680, rates would be 3.375. It would make her payment $2,800. $2,800 on here, okay? So it's $2,800. Francis, let's go with an FHA payment. If you have a purchase price out there, let me know the purchase price and your middle credit score. Let's say we go with an FHA loan. FHA 445. Right now, rates on FHA is going to be 2 with your credit score, 2.75. See, if you go FHA, everything's calculated for you here, except for Melrose and HOA. Makes your payment $2,600 a month. All right. Hopefully that helps you out. So K5 Castro, I think it is. What's your middle credit score? Let's say we go with 490. 490 right here. 490. Let's go up. 490 right here. When you need to know your score. 490. FHA is pretty easy. You just got to put in the purchase price, right? It calculates the rest for you. Unless you know you're in an area that has a higher property tax or lower one, right? 490. FHA 2867. All right. So that's on an FHA. Conventional would be different. And that right there, guys, is how to calculate your mortgage payment. Hopefully that was helpful. That was useful. Like I said, here we'll do one more for Eric here. Eric, we need to know the credit score. Eric, 768. This guy is good. Good job. Thanks, Cheryl. So let's say 580, right? Let's go 580. We went with a 580 credit. We went with 580 purchase price. How do you do 40-year loan fix? You can change the terms on here. So let's say I'll do Trish. If you want to do it, just change here. Go up to 40 years. Right? But here, let's go 30 years. For Eric, 40 years stretched out. Bruno, I'll answer that in a second. 30-year on a conventional, right? Let's go conventional. 768. I'm going to go with conventional. I'm going to go 5% down. Right now, conventional rates are going to be 3.125. 5% down. 768. Right? I would go right here to conventional. 768. So 5% down would be, see here, my mouse is lost, would be 0.38, right? 0.38. Let's say there's two borrowers on there. You would get rid of 0.909, so it would be 0.29. So this would be 0.29, which would make your mortgage payment $3,170. Would make your mortgage payment $3,170. So your purchase price would be $580. It would make your monthly payment $3,170. Hopefully that helps you out. So Quinton, 480, 10% down. I would go conventional, Quinton. Let's say we go 480. 480, 1, 2, 3. 10% down. Really not going to change the rate that much. 720. So we go to the PMI. 10% down. 720. 0.46. 0.46 minus 0.07 for two borrowers. 0.46. See, what's this? 0.46. It would be 0.39. Which would make the payment $25.50. Okay, $25.50 on 10% down. Yeah, Castro, if you're gonna go 620, it would change it up big time. In this environment, what kind of lender is best? All right, guys, let's get some Q&A. If you have more questions, Castro, please message me. Laura Bermudez, I'll do one last one for Laura. This is the last one, guys. Then I'm gonna go some Q&A. 530 right here. 750 score, 5% down. We're going to go conventional because you have a 750. 5% down. Raise 3 1/8 with a 750 score. 750. 5% down. 750 would be in this range 0.53. 0.53 minus 0.09, 0.44. So 0.44. Which would make your payment $29.59. All right. Let's go all up here for any ones who have questions. Some Q&A questions really quick here. I'll answer everyone's questions right now. Guys, if you have questions, please ask. Thank you, Rosalinda, about the HOA, right? Can you talk a bit about Mello-Roos? So Mello-Roos is when your city borrows money, right? It's kind of like a bond. They're borrowing money. And how they pay back the money is they charge Mello-Roos. So Mello-Roos has an end date. Depending on where you live, what they're building and what they need the money for, right? They're borrowing money, and how they pay back the money is by charging Mello-Roos to people who live in that specific area. So if your area has Mello-Roos, you're paying back a loan that area is borrowing, if that makes any sense, right? Typically, there is an end date. Typically, Mello-Roos is about 20 to 30 years old. But they can increase, though, right? If they decide to do something to that area. Hopefully that helps you out. What does escrow mean? So escrow, Bruno, is a third-party company. It's a neutral party to keep everyone honest. So when you're in escrow, that means you have an active transaction. That escrow, the third party, is keeping everyone honest, right? So if you're buying a house, you're in escrow, it means you have an active transaction. That an escrow company, a third-party company, they're making sure the buyer's honest, the seller's honest, the mortgage company's honest, and anyone else involved in the transaction to make sure everyone gets where they're supposed to and follows through before they release the funds, okay? If you do a big bet, people put the money in escrow. It's a transaction. Escrow is a third party that manages the money and honors all the contracts. Hopefully that helps you out there, Bruno. Mary Jane, hi, man. Are you aware of a construction delay? Yes, there is a huge construction delay right now, right? Material, getting people to go to work, right? There's shortage on labor and there's shortage on material and delivering the material, all right? John, thank you so much. Thank you so much, John. Thank you so much, Sandy. Jolene, can you suggest who can finance buying a mobile home? Typically, there's only two main companies in the United States that finance them. I don't know the name of it, but they are out there. But typically, there might be a few companies, but they all lend through two main companies. Typically, if you want to buy a mobile home, you would call a mobile home, whoever's selling mobile homes, and they already have the financing company ready for you, okay? Cheryl, how you doing? Francis, what's going on? Thank you for the numbers. Castro, hopefully that was helpful. Eric, what's good? Cheryl, you're welcome. Eric, you're welcome. Gus, you're welcome. Trish, what's going on? How do 40-year loans work? Typically, when loans are amortized over 40 years, that payment's even cheaper. I would not keep a 40-year loan longer than 3 years. Typically, I would do a 40-year loan to get the cheapest payment possible, but after 3 years and I have enough equity and the PMI falls off, I would probably refinance to a 30 or 27-year fix, right? Right now, home equity goes up about 5% a year. So if you do a 40-year loan in 3 years, you should have close to your 20% equity, right? If homes appreciate at an average of 5% a year, right? I know it's been some crazy numbers recently, but average historically, it's about 4 to 5%. So if you keep a home for 3 years, you have 50% equity, but in 3 years, I'm sure you pay down a portion of your principal. So in 3 to 4 years, if you have the 20% equity, refinance out your 40-year loan, do a 30-year loan or less. But remember, you're not going to have PMI, which would make your payment cheaper anyways. Hopefully that helps you out. Let me see here. Thank you for sharing, Cheryl. We talked about the 40. Bruno, hopefully that answers your question. Quentin, hopefully that was helpful. Guys, if I did your scenario, do me a favor, share this video and save it, right? It helps the algorithm. FHA or conventional loan, what's the best? Quentin, if you have above a 720, I like conventional. Others under 720, I like FHA. The payment is cheaper, right? And typically if you go with an FHA, work on your credit and refinance to conventional when you have the credit score. How did 4-year loan work? I hope I explained that. I see it's an option with some lenders, but is there a downside beside more interest overall? No, there's not a downside. Like I said, more interest overall. That's the only downside. There's nothing else that's negative about it. I wouldn't keep a 40-year loan longer than 3 to 4 years, okay? What's going on, Eric Castro? Hopefully that was helpful. Let's see here. Zode, in this environment, what kind of lender is best? Zode, right now, if you're going to go with Zode has a great question. In this environment, what type of lender is best? Any lender that moves fast, right? A lot of times it's not even the lender, it's the loan officer, depending on what team they work on. Typically, if they work on a team that has, like there's a team I do work with, right? They're part of Loan Depot. This team has their own underwriters. They're going to slam your loan like this, right? I send some loans to them. I think the bigger banks like the Loan Depot and the Movement Mortgage, the Guarantee Rates, the New American Fundings, they're going to be really good at renovation loans. They're going to be really good at down payment assistance. They're going to be really good at at spot approvals, right? Anything that allows a escrow holdback, they're going to be really good. But if you're going to go with your standard conventional or USDA, I would go big banks all day long. But if you're going to go with a conventional loan, FHA or VA standard one, right now I would go to the small direct lenders, not the big brand, because all that corporate margin, right? We talked about in a video before, and also mortgage brokers, right? If you're refinancing, mortgage brokers, or some of these bigger banks, they're just doing that they're undercutting everyone, right? Like owning, okay? So, like I said, for me, I'm about the people. It doesn't matter where I work or where I start my loan. If you ask me straight up, if I would go to the big banks if I was doing down payment assistance, if I'm doing any spot approvals, any renovation loans, or any escrow holdbacks, right? They're great for those. They got the juice, they got the money, and they got the resources, right? If you're going to go with a traditional loan, I like small direct lenders right now because their margins, they can afford to go lower on the rate. Same thing with mortgage brokers. If you're going to do these stated non-qualified mortgage loans, this DSCR, or you're going to go with like 24-month bank statements, then I would go with a mortgage broker. It depends on your scenario, all right? People ask me about credit unions. I'm not the biggest fan of credit unions because after the pandemic, I noticed they're not taking a lot of risk. They're kind of giving you higher rates to kind of tell you we don't want to do your business, right? And if they do want to do your business and their rates are low, their guidelines are really strict. It would be hard to do a deal with them, okay? Does the calculator do down payment assistance? Typically, with down payment assistance, you just put in the interest rate on the down payment assistance because you're typically on down payment assistance the second and the third. It's either a silent second, it means there's no interest rate, or you pay the interest after 30 years. So, Gus, when you're doing using the calculator, just put in the interest rate of the first loan. That's all you got to worry about. Hopefully that helps you out. This is great. Just stop by to say what's up. Thank you, Daniel. You're welcome, Laura. Bruno was good. What's going on, Mahan? Cheryl was good. DE, can you talk about what makes an offer competitive when sellers are evaluating multiple offers? So DE, what makes an offer competitive? What makes it competitive is right now it's still a seller's market. I know you guys are reading the news and everyone's talking about, oh my God, prices are coming down now. Go write an offer and see what's up. the prices that are coming down right now, do you guys know it's mostly these Johnny-come-lately real estate agents who are overpricing the property because they overpromised to their seller because they wanted the deal and like, you could sell it at such and such. If the home is priced right, it will sell within 2.5 weeks. Try to write an offer. Yes, there's certain areas it is slow, like Imperial County, right? But if you're in a metropolitan area, if you're able to watch this show right now, most likely you have Wi-Fi, right? You got solid Wi-Fi, and you're in an area that probably is decently populated or overpopulated. Try to write an offer, see what happens, right? So in a competitive market, I would not ask for closing costs. You can ask and see what happens, but if you don't want to risk it, I wouldn't ask. I would ask for full price. And if the home doesn't appraise, work a way to cover the difference. Your appraiser, your lender should know, or your realtor should know if you're reaching, which means you're asking too high, but the home doesn't appraise, right? I would go purchase price. If the home comes in short, I'll come in with the difference, right? And I would give the seller 60 days to move, right? Don't forget, they still got to find a house as well. I know a lot of people don't like to do that, but if you want to be competitive, right? Some of you guys don't like what I say. This is just my opinion. I work with a lot of realtors writing offers. A lot of them are going full price, over asking price, coming in with a difference. But the main one, giving your seller time to move. A lot of people don't want to do that. They're like, I'm buying it and I'm already overpaying. Why would I do that? Don't forget, it's a seller's market. They got to find a house too. And if you don't make it easy for them, they're not going to make it easy for you. Hopefully that helps you out, DE. Thank you, Shake, for sharing. Eric, do you believe people will stop outbidding each other by next year? I don't know. I honestly don't know. Rates should be going off. They say they are tapering by second month or second quarter. I forgot what they said, right? But they're going to be tapering and not buying mortgage-backed securities as much. So if they do that, right, it's going to drive up rates. But how deep will the rabbit hole go? How deep when rates go up, will people back out? Rates hit 3% last couple weeks and applications are up. So I think a lot of people, they're just not building enough homes right now, right? A lot of times, if you want to buy a home, you might need to think out the box and go further out to have a higher chance to either be the bigger fish in the small pond or there's not enough fish in the pond. If you are a regular fish or even a big fish in a big pond, it is competitive. Write a couple offers, see what's happened. Thank you, Cheryl, for that answer. Quentin, definitely helpful. Would it change the payment much between 5 to 10% down? Yes, it would probably change. Depend right now. Quentin, for every 50,000, it's $350 a month. So if the down payment changes by 50,000, it'll change the payment $350. If the 5% 480, right? So 5% down would be what? Let's say 500,000, 5% out, 15 grand, right? It's really not going to change it that much. I would go 5% down, right? You can use a calculator, put it side by side, 5% and 10%. I would go 5% down, Quentin, and save that 5%. It wouldn't make too big of a difference, all right? You're welcome, Laterio. Trish, how do appraisals work for new construction? So they typically order appraisal, so that's why a lot of builders want to go with their own lender, because when you buy new construction, there's not enough comparable sales to give the property value, especially in phase 1, right? So that's why they like to use their own lender. But after the home is done being built and all the utilities are turned on, an appraiser will go out and appraise the property. I see a lot of properties coming in short because you go there and you add all the bells and whistles to the property. Adding all those amenities doesn't bring up the value like you think. So I've seen people overpay by 30, 40,000 because they're like, oh, why did the home appraise? Well, you added a bunch of amenities that doesn't bring value. It just makes the property look better. So be careful of that. Hopefully that answers your question. Sorry for the audio delay. You're welcome. Palma.
Your audio delay.
Oh, hey, man. Do you think Riverside County will increase FHA loan limits now that conforming? It should. Conforming's going up. FHA should go up. We won't know about Palma till about FHA till probably after Thanksgiving. That's when they normally release it. Do 40-year loans typically have interest rates higher than a 30? For right now, I see the rates are the same, Trish. If you are buying a 4-unit property, what loan do you recommend? If you are going to move in it, go FHA. When you go FHA, it's 3.5% down. But remember, with FHA, when you go with a 3-unit or 4-unit, there's something called the self-sufficient rule, which means 75% of the market gross rent has to be more than the mortgage payment. And if it's not, you cannot go FHA. So if you can't go FHA, then you got to go conventional. But do your best to go FHA, Bruno. Trish, what do you do if the new construction home doesn't appraise? Do you have to come in with the difference? The answer is yes. You have to come in with the difference. What up, Anthony Sabri? How you doing, brother? Yeah, if the home doesn't appraise, you can have your your buyer's agent negotiate. That's why I do recommend, Trish, that you go with your own buyer's agent. I don't recommend use a seller agent, right? Go in with your own buyer's agent. If the home doesn't appraise, you can butt heads. Work it out. Especially, let me tell you a secret, Trish. You threw in all your amenities already. It's your custom amenity. When someone buys a new construction, they don't want to buy someone else's amenities. They don't want to buy someone else's floor, someone else's walls. So if you go a little crazy and it doesn't appraise, most likely they're going to sell it. It depends on how off you're off by like 10, 15 grand. I think they'll back off. Why do I think they'll back off? The reason why, someone else doesn't want to buy your taste. Now, I'm not saying that your taste is bad, right? But everyone has their own taste. All right, hopefully that helps you out. Everybody has their own taste. So definitely, if you buy new construction and you have a specific taste and that other seller, it's going to be hard to sell if you don't buy it. So that's why, but I do recommend your own agent, okay? Hopefully that helps you out. Yvette, I'm buying a duplex, North Carolina. The seller listed at 160. However, the appraisal came in at 141. The seller still insists of selling it for 160. Should I still buy it? I would have to pay extra 19 grand. Yvette, if the other units rent out, do it. Definitely do it. I would buy it. Why? They are continually raising rent, right? Buy it, right? Right now, 1 out of every 4 home properties are single family homes up to 4 units are bought by investors. They're just parking their money here, right? They're parking their money here and let rent rise and eventually cover the mortgage, right? So definitely I would do it. I wouldn't back off on it, right? That's not that big of a deal. That's not that big. 19 grand is not a big deal. I would definitely do it, right? Make sure it makes sense when you do the rent, right? If the other unit is rented out, I don't know if you're buying it as owner occupied or investment. If it rents positive, if you're buying it as an investment, it rents positive, definitely, right? You'll make up that 19 grand like that in equity and in time in the next 24 months. I would definitely do it. RJ, what's good, man? What's your opinion about Cal HFA? I love Cal HFA. If the purchase price is under 400, 450, and if a seller's willing to take Cal HFA, do it all day long. Why do I say under 450? Because of the rate, right? Typically with the rate on down payment assistance, when you start going into higher loan amounts, the spread between down payment and non-down payment for monthly payment is way too high. So under 450, I like that. Julianne, just in case, I started following your page from last year, and thank you. Have been able to become more informed about different mortgage products out there. You're welcome, Juliana. Trish the fish. I meant I'm buying new construction and I didn't add any upgrades. I'm buying it from the builder and will be the first to live in it. Does the appraisal still work like that? You can always negotiate. You have not because you asked not. If you didn't do any upgrades and it didn't appraise, it should appraise. But if it didn't, go back and see what you can do, right? Sometimes they might work with you, right? If you didn't do any upgrades and it's already done, most likely you have all the standard stuff in it. Someone else might not want to buy it because they want to put upgrades. So they might, you know what? Take the house, right? If you get it in the earlier phases, most likely it should appraise. Hopefully that helps you out. Guys, that is all for us tonight. If you enjoyed our content, do me a huge favor. Save this video, share this video, and like it. And if you are been watching till this part right now and you haven't followed yet, please follow our page, right? Thank you guys so much. Juliana, one question. Should I shop around for a mortgage rate first on my own or contact a real estate agent and go through the lender they work with? If you feel comfortable, I'd check it out, right? When that lender runs your credit, ask them for your 3 credit scores. What I would do it sounds kind of busted or ghetto, or it sounds kind of jacked up, have that lender run it. You need one lender to run your credit. Grab your score, talk to 3 other lenders or 2 other lenders, right? Whoever gives you the best deal, take the best deal and go with the lender that you are the most comfortable with. If it's with your original lender, great. If it's not, go to the other person. And once they run your credit, if your FICO drops, just go back to the person who ran your credit and have them honor the better deal, which most likely they will. Hopefully that helps you out. So thank you. Both units are currently rented at $650. That's $650 per month, and we are planning to raise it to $850. We are paying 25% down, and our mortgage is $650. Yvette, if you don't take that property, send it over this way. You see what I'm saying? Like, you're parking 25% down on your money, and you're making a profit, right? Before the seller wakes up, take it and run. All right. Hopefully that helps you out. You're welcome, Mahan. How long till your house can be part of your equity for another home? Now with a loan with the second. If you're doing a cash out refinance, you can go up to 80% of the appraised value. If you're doing a home equity line of credit, you can go up to 90% to cash out to buy your other property. Hopefully that helps you out. If you have more questions, RJ, please reach out. Guys, if you do need to get a hold of me, here's a number, 714-790-9697. Give us a call or text us. If you have a loan estimate, you want us to help you read it or beat it, send it to info@whatsamortgage.com. All right, and we'll help you review it. If you just need help reading it, send it over. But if you want us like just beat it, right, tell us, and we will find someone out there that will beat it for you. All right, guys? Guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much and have a great night.